Having understood what is meant by assessment year and previous year, let us now move to some of the characteristics of income tax. Now, income tax basically, as we also saw in lecture number 1, is a direct tax. That is, the person on whom it is levied has to bear the burden or make the payment. You cannot have someone else pay your income tax. Okay? Second is, it is an annual tax, which means that income tax is to be computed on your annual income. So we saw earlier the concept of previous year, which is 1st April to March 31. So whatever you earn during that particular year, financial year, or the previous year as we call it, on that income you have to compute your income tax annually. You might be required to pay it in by way of advance tax in quarterly or maybe whatever, depending on what your status is. But the tax is an annual tax. It is levied on the income of the entire year. The third point is that it is governed by the Indian Income Tax Act 1961. So this is the statute which basically prescribes how these incomes are to be taxed, what are the compliances to be followed. Of course, there are income tax rules which also play an important role in the implementation of the provision of Indian Income Tax Act. But basically, the statute or the law is governed by the Indian Income Tax Act 1961. Tax of previous year is charged in the immediately following year called the assessment year. So basically, what happens is that tax of previous year. So we saw what do you mean by a previous year and what do you mean by an assessment year. So basically what happens is whatever income you have earned in the previous year, whatever tax is due on that is charged in the immediately following year called the assessment year. So you earn in previous year, but you are chargeable to tax in the assessment year. The meaning of these two we've done in the previous lecture. You can refer it. Tax is levied at rates of income tax fixed by the relevant Finance Act. So what happens is that every year there's a finance bill which is coming in the budget. You must have been hearing a lot about this. Okay. So once the budget presents this finance bill and which is passed every year, it becomes a Finance Act. So the rates of taxes which are to be levied on incomes earned by a particular set of person or different set of person is fixed by the relevant Finance Act. In case the Finance Act has not been passed as on April 1 of the relevant assessment year, provision of the Finance Bill / previous Act, whichever are beneficial to the taxpayer, applies. This is important. Let me explain it to you. Now what happens is you have normally a finance bill which comes generally in the month of February / March. This contains various provisions. Okay. So let's consider the current scenario. So there was a finance bill 2011 and let's say there's a finance bill 2012. This bill, which is presented in February and March of relevant year, is normally passed by April the 30th. And same for this also. Okay. Now until and unless this is passed, what happens? Let's say for example, we know that our previous year or the financial year starts from April 1. Right? So on April 1, if this is not passed, then what will happen? In such a case, the assessee has an option to take either the provision of the earlier finance bill or, so this bill would have been passed, you can consider either the provision of this or this, whichever are more beneficial to you. Okay. Whatever provisions are more beneficial, you can consider that, and basis that you can determine your tax liability and payments of taxes and other provisions. Right? Applicability of the law as on April 1 of the relevant assessment year. So let's say for example, what happens is there is some change in the law on April 15th. Okay, let's say April 15th, 2012. Now the assessment year which is running here is assessment year 2012-13, which is relating to previous year 2011-2012. Right? So the question which comes up is, which provision am I supposed to see? I mean, there's a law change on this date. Okay, but is this applicable to my case? The answer is no. Why? For assessment year 12-13, whatever is the law on April 1, 2012 is the one which has to be seen. Any changes after this date are not applicable for this year, but they will apply for assessment year 2013-14 onwards. Okay? Pure procedural changes applicable from amendment. So what can happen is that instead of changing the law, there could be some procedural amendments. Let's say, for example, form in which the IT return is to be filed. So if the government changes the form in which the return is to be filed, or interest payment on detail late filing, etc., which are more of procedural in nature or something, not relating to the law per se, these changes can be made effective from the date when they are notified instead of April 1 of the relevant assessment year. So these characteristics are important as you move ahead with your income tax journey. Okay. If you like this video, please provide us your feedback, or you can also hit the like button on the YouTube channel which is playing here. Our purpose is to educate as many people as possible. This is Arinjay Jain, your educator. Okay. Look forward to seeing you in many more of such lectures.